So effective in 2024, we're going to have an increase in the taxes, state disability insurance for employees to fund family paid leave and a couple of other things. The tax rate is going to go up from 0.09% to 1.1%, fairly insignificant number. However, historically, the collection of this tax has ceased once a taxpayer has earned $153,000 a year. Now the amount of taxes to be collected will be unlimited, so that if someone makes $1 million a year, instead of having 1.1% of withholding against the first 150,000, it's now going to be against the entire wages of that employee. So it's a big change for higher paid employees. Money again going to paid family leave, going to increase the percentage of weekly income that an individual taking family leave will receive by a significant percentage, allowing some people to actually take the family paid leave rather than returning to work because of the delta between what they were receiving before and what they're receiving under the new law. So what's happening now is that employees that are earning significant salaries are now exposed to a 1.1% tax on all of their payroll. Huge numbers, huge differences. It is just one more straw on top of the camel's back, so that the highest paid employees in the state of California are going to now be faced with the top 13.3% tax rate on normal income plus this 1.1%. At 14.4, we now rank number 2 in taxation in California. So it's a huge tax rate. I think over time, the size of the total tax rate, just adding a little bit more, is going to cause more and more people to wonder whether they should be working someplace other than California. And maybe the best way to put it in perspective is it costs $7 a thousand, give or take a little bit, to buy a house. So if I want to purchase a home, another 100,000 is going to cost me $700 a month. Well, think about, the individual who has a significant salary. If he now is in Texas or Nevada, Florida, and there's no individual taxation, he suddenly walks away from a 14.4% tax on his income in California, and he has more disposable income. He can buy a much, much bigger house. So that moving the numbers, the ability to spend that money, and if you talk about buying a house with this, let's assume that you move to Texas, no state tax. Now I've got another $15,000 of income every year, more than $1,000 a month. I can buy a much bigger house. Not only that, I'm going to get a federal deduction for my interest expense. So my ability to live at a higher level is going to be increased significantly. So it's not the 1.1%, it's the cumulative of all these taxes in California. For somebody who's making $85,000 a year, this is truly an insignificant tax increase. They're not going to notice $5 or $10 a month disappearing from their payroll. So this is strictly, in terms of impact, impactful on people who are making significant money. Let's just put it in the category of people making more than $150,000 a year. But those are the individuals, cumulatively, who pay almost all of California's taxes. So if they decide the total tax burden is too much and they leave, they go to some other state to improve their lifestyle, the state of California loses money. And that's what's happening. That's real world, that's real time. That means at some point that public services need to be reduced. Ultimately, the burden falls back on the rest of the citizenry. The passage of the tax has gotten very, very little publicity. Again, because it's such a small tax, it's such a small number, 1.1%, and very few people, but the biggest taxpayers, are affected by the loss of the cap, so they're now taxed on more income. But it's gotten virtually no publicity whatsoever. I mean, as we all know, California has significant budgetary issues, Here we're increasing a benefit, family paid leave. Pretty hard to argue against family paid leave, but we're increasing the percentage of the weekly income that people will receive. So money has to come from someplace. The experts on areas like this are going to talk not about moving the rate from 0.09 to 1.1 or taking the cap off. What people are going to talk about is, what does it cost a taxpayer to live in the state of California relative to living in another state? That huge tax rate in California has become costly to the state in terms of revenues and costly to the state in terms of people moving out. If you look at the Chapman forecast, we're seeing the increase in higher paying jobs, the tech world, et cetera, has gotten very, very small to negative. And there's no reason not to think either that the increase in job growth will continue to be slow, and no reason to think that the state of California will not, because of this expected huge 60-some-odd billion dollar deficit, will not continue to nick away at taxes and try to collect more money to make its balance sheet work. And should we continue to increase taxes as we have revenues go down, it's self-fulfilling that the higher we raise taxes, the less taxes we will collect. There's a gentleman named Art Laffer, who I think is now holds a presidential medal for his work in economics, who proved that when we lower taxes, we collect more revenues. And it's been true in income taxes for time eternal, I guess. But as we raise taxes, people do all of the steps that they can to pay less taxes. Therefore, the state has less revenues.
If you haven't checked out CaliforniaInsider.com, we highly recommend you do that now, because we're going to have a lot of news and videos there. And on top of what we have there right now, we are building a really big platform to cover what's happening in California, so you can be informed. We're going to have more shows, more videos from all aspects of life in California. Go to CaliforniaInsider.com and we'll see you there.